Hi, good evening everyone and welcome to Hibiscus Petroleum's Q4 Financial Year 2025 Results Briefing. It's the eve of a long Merdeka weekend and we appreciate you joining us today. I'm Lily Ling, VP of Corporate Development, and with me today are our Managing Director, Dr. Kenneth Pereira, our CFO, Yip CY, our Country Head of Malaysia and Vietnam, Dr. Pascal Hos, our Head of Corporate Finance, Joyce Vasudevan, our VP of Economics and Business Planning, Deepak Thakur, and from my Investor Relations team, Andrew, Adam, and Zehan. Alongside our Q4 Financial Year 25 results, we also announced a dividend declaration, independent competence person report for both Anasuria and Brunei, and our corporate and business update with operational performance details. All these announcements, together with today's briefing slides, are available on our website. With that, let's begin. Over to Joyce.
Good evening, everyone, and thanks for spending part of your Friday evening with us. Thanks very much for that. For financial year 2025, we've had a remarkable year actually in terms of what was within our control, which is to grow the business in terms of delivery of increase in volumes, increase in 2P reserves and 2P resources, we have delivered. But however, the profits do not tell this story because it's been weighed down by macroeconomic factors which were not within our control. So if we look at the first point, significant volumes assets growth, our oil and gas sales grew by 14%, production by 27%, and our 2P reserves increased by 70%, which is about 40 million barrels of oil equivalent, 2C resources by more than 90%, which is 55 million barrels of oil equivalent, and this mainly came from value accretive deals, which is the acquisition of the gas-producing asset in Brunei, the award of PKNB cluster with 4 discoveries, and then the unprecedented 20-year extension of our key PSC, which is PM3CA PSC. All this translates to an additional 7 years of reserves and resources life. However, as mentioned, our profit after tax has declined because of factors not within our control, which is the decline in average oil and gas prices, a weaker US dollar, because our revenue is denominated in US dollars, and also a one-off non-cash deferred tax liability charge for the UK Energy Profits Levy that was reported in the last quarter results. However, our financial performance does remain strong. We have robust cash flows, cash position. Our capex and our Brunei asset acquisition, the Brunei asset acquisition, we paid $196 million for that, and all that was fully funded by internal cash and financing facilities. We did not have to issue any equity for it and dilute shareholders. And in terms of revenue, above 2 billion for the third year running, EBITDA more than 1 billion for the fourth year running. And in terms of dividends, we have declared half cent in fifth interim dividend for financial year 2025, and on top of that, we've also declared another half cent final dividend, and that's subject to shareholders' approval. So that takes the total dividends declared in relation to financial year 2025 to 9 cents. We've paid 8 cents, so now it's 9 cents, and this is the highest dividend declared in the history of Hibiscus. It surpassed our 2025 minimum guidance, and that translates to a dividend yield of 6%. So the key to the fundamental point to make here is that we have succeeded in financial year 2025 in building a bigger, stronger, more diversified asset portfolio, which will now form a robust platform in which we will then look towards achieving our 2026 target of 35,000 barrels of oil equivalent, and then onwards to our 2030 target of 70,000 barrels of oil equivalent. And in terms of this is the financial and operational metrics. And as I mentioned, if you look at the increases, the production has increased by 27%. That's almost 27,000 barrels of oil equivalent. Sales volume is the highest ever that we've achieved. That's increased by 14%. And if you look at net Opex, we've achieved a reduction in net Opex $27 to $22 barrels of oil equivalent. But however, because the average oil price has gone down by 16%, that's $92 versus $77. And then also the US dollar has depreciated about 4.7 to 4.37. So that has resulted in a decline in revenue, EBITDA and profits. With regards to profits, as I mentioned in the first slide, that there was this one-off levy, and it's a non-cash deferred tax charge of 173 million. If we add that back to the PAT, the normalized PAT is actually 291 million ringgit. So the point to make is that in terms of what we could control, we have achieved, we believe we have had a very successful year. In terms of dividends, as you know, usually at the start of the financial year, we provide a minimum dividend guidance at the start, and so that based against an oil price range, to give shareholders an idea of what type of dividends to expect for the 1 year ahead. And we also try to pay this every quarter. And another point to note is that the minimum dividends is actually a priority spend in our capital allocation framework. So it actually ranks above our sanctioned capex. So in terms of financial year 2025, our dividend payout has surpassed our minimum dividend guidance. Our dividend guidance for the year was between 8 cent to 10 cent based on oil price of $70 to $80. And the 9 cent, so the 9 cent is actually a lot, is higher than the 8 cent that we achieved. And this is the second year running that we have exceeded the guidance. In 2024, with the minimum dividend guidance was 7.5 cents, and we paid an actual of 8.5 cents. You notice on the right-hand side, year on year, we have been increasing our dividend year on year, and in the last 5 years, our dividends have actually grown by 2.5 times since we first started the paying maiden dividend in financial year 2021. And in terms of total spend of dividend and share buybacks, for financial year 2024, we paid dividends plus share buybacks, we spent about 79 million ringgit. And in 2025, combined, we spent 184 million ringgit. And the point to make about the share buybacks is that in total since December 2023, we have spent about 134 million ringgit share buybacks, and that equates to about 8.4% of our share base. And we have cancelled all of this, so there is a positive impact on EPS as well as net assets per share.
Okay, thanks, Joyce. And good afternoon, good evening, everyone. This slide, we talk about the 2P reserves. 2P reserves for at the end of or updated 2P reserves resources as of 1st July 2025 on the right-hand side. And left-hand side, we are showing the reserves replacement ratio, which is very, very important key parameters to see how company is strengthening their production and reserves portfolio. So we are showing for 2 time interval. First one is between 2017 to 2024. We produced 31.3 million barrel of oil equivalent, oil and gas. And then against that, we added 63 million barrel of oil equivalent. So the reserves replacement ratio for this period was 201%, which is very, very strong number. If you compute it the same reserve replacement ratio for last year, 2024 to 2025, the number is 439%. We produced 9 million barrel of oil equivalent with the Brunei asset acquisition and also PMCCA PSC extension. We have added 39.5 million barrel of oil equivalent reserves. So as of today, our reserves, 2P reserves, stand at 88 million barrel of oil equivalent, and our 2C resources stand at 108 million barrel of oil equivalent. If you were to take very conservative approach assuming only 50% of 2C resources would be converted in next few years to 2P reserves, our reserves and resources life would be close to 15-16 years. So this is the runway we have based on the current reserves and resources. Okay, now let's go to the next slide. This slide we are showing the key milestone we have achieved as a company last 1 year. Let's start with the first two. So in July and August last year, on the back of our strong operational performance and the safety record, we were awarded, we managed to get 2 PSC. PKNB is a development asset where we managed to get 65% participating interest, and we are the operator and our partner is Charigali. And the second PSC is PM327, which is the largest exploration block in the offshore West Malaysia. We have 35% stake. So on the first one, PKNB is very, very important, especially given the fact that we have set ourselves target to increase or to double our production numbers from 35,000 to 70,000 barrels per day, barrels of oil equivalent per day, from 2026 to 2030. So PKNB would be playing important, very, very important role in terms of those volume growth. And PM327, subject to commercial discovery, we would try to tie the oil and gas in the PM327, and we will produce via the PM3CAA gas processing plant, gas processing facility. Coming to the third point, which is regarding the dividend, Joyce talked about it. For FY2024, we paid 8.5 cents per share as a dividend against our initial guidance was 7.5 cents per share. Similarly, in FY2025, we have allocated 9 cents per share against the lower range of guidance 8 cents per share. And then fourth one is about the Brunei acquisition, which we completed in October 2024. This also helps us to have the new country entry of Brunei. As you know, Brunei as a country is significantly dependent on the oil and gas. So we see it's good. This acquisition will set a kind of stepstone for us for future or significant growth in a Brunei asset, and also to achieve our or it will also give us like inorganic opportunity to grow our portfolio in Brunei. So we acquired this asset from Total. We paid close to 196 million US dollars to close this transaction, and the entire consideration was paid from our internal cash and existing debt facility. Then PM3CA extension, as you know, we managed to get 20-year extension. It also this 20-year extension up to 2047. So we are going to produce PM3CA with the help of PKNB up to 2047, 2048. That kind of so next 20 years we are going to produce. This extension has added a considerable amount of 2P reserves and 2C resources. Here we are also mentioned the two recognition. We were recognized on Forbes Asia's 2025 Best Under a Billion list, and also ranked as Fortune Southeast Asia 500 company. With all of those effort in terms of the acquisition in Brunei, PM3CA extension, and PKNB award, collectively it adds to close to 40 million barrel of 2P reserves to Hibiscus reserves portfolio, and 55 million barrel of oil equivalent of 2C resources. A considerable amount of volumes which we are going to produce in next 10 to 15 years. So it has also helped us to extend our reserves and resources life considerably by close to 7 years. Okay, then Siva will take us through the financial summary.
Thank you, Deepak, and thank you for attending this evening. I will run you through some of the key numbers from a financial statement perspective. Now, if you look at this chart, before I go into some of these key numbers, just to reiterate what Joyce mentioned on slide 6, there were some, we can't control macroeconomic factors, and they include the selling prices that we have attained during the financial year, and also Forex. So we obviously report our numbers in Forex, in Ringgit Malaysia, and our revenue comes in the form of US dollars. So the currency, that particular comparison has gone down by about 7%. If you look at that slide, the downward trend of both oil and gas prices range between 14 to 16%. Now, despite that, the numbers that we have shown on this page, if you look at the overall context of the environment, they are pretty impressive. This is a full financial year comparison because this represents June, obviously is our financial year end, and so this represents 12 months of financial results between FY 2025 and FY 2024. Now, I'll start with the revenue. You will see that our revenue for this financial year is 2.3 billion ringgit Malaysia. And that is an important number because that would mean that for a third consecutive year, the Hibiscus Group has managed to record more than 2 billion worth of top-line revenue. And obviously that was made possible this financial year, despite the lower prices, because of the addition of the Brunei segment, where we have recorded about 8.5 months of its contribution since we took the asset on in the middle of October 2024. When it comes to EBITDA, we have attained just above 1 billion. Another quite important achievement, because this would also mean that we have attained an EBITDA of above 1 billion RM for the 4th consecutive year. So again, a very important milestone. Then I'll move on to the profit after tax line. Joyce also mentioned earlier, and also we have reported and explained in earlier quarters, in the UK, because of legislative changes to the energy profits levy during this financial year, we have recorded in total a non-cash, deferred tax liability charge of about 173 ringgit Malaysia equivalent. That is a one-off charge, obviously, and we all know that it's going to be reversed over time until 2030. If you add that back to what we have reported, which is 117.5 million RM, that would bring us to 291 and much closer to what we have attained last year. Now, I think what is a more important achievement or attainment during the financial year is that our cash flows, despite all these P&L numbers, have grown, have improved actually by quite a significant margin of about 7%. Last year, our total operating cash or net operating cash flow was just above 800 million. This year, despite all these factors I've just mentioned earlier, we attained almost 870 million. That's really that's one point we need to highlight. Maybe a side note is that you see that we have a few producing assets, but it's worth noting that due to our planning and phasing of activities and and of course benefits that come from the respective tax regime in Malaysia and UK, in financial year 2025 we were not required to pay any taxes for the Kinabalu PSC in Malaysia and also for the Anasura cluster in the UK. So both of these producing assets were not charged any taxable or any corporate income taxes. Okay, I'll move to the next page, and this next page is where we want to highlight certain key areas in our cash movement, or rather cash utilization and generation. right at the, from the far left corner would be where we started the financial year from a cash balance perspective, and right at the end would be where we ended. A lot of things have happened during the year, but in short, the important thing to note is that it is a year with a fairly heavy capex. It's a fairly heavy capex year. We have incurred just slightly above 800 million RM worth of capital expenditure. But if you can also see the second bar, we have generated free cash flow of 867, as I mentioned earlier, and that would translate to this message that, as we have always mentioned in the numerous briefings and sharing, we intend to finance our capex using internally generated funds, and this has been the case for FY 2025. So that was the second, third bars. Then I move on to the next two. You will see that we have drawn down facilities of close to 540 million during this FY, and a large part of that, or maybe the entire, that would translate to the fact that we drew it down to acquire an asset in Brunei, and we all know that asset now. This obviously allows us to enter into a new market with a lot of potential. So the debt was used for future growth. Now, with all this debt, one point to note out is you'll see that there's a particular area called net interest payment. So with interest expenses and all, we have managed to maximize or optimize our placement of funds of unutilized balances from time to time. And you will see that, instead, despite the fact that we have all these outstanding facilities, our net exposure for the financial year is very, very low, just merely 4 million RM of net interest expense over income. And I think maybe one of the most important factor here is that during this year, we have invested more than 200 million ringgit Malaysia into dividends and also share buyback. We paid dividends of almost 90 million, and our share buyback, we invested about 120 million into our share buyback activities. So all in all, what's the summary of this entire year from a cash perspective and also debt perspective? Our gearing remains extremely low. Gearing ratio is only 28% despite all these activities. And very importantly, you'll see right at the box on the far right corner, right at the bottom, we still have unutilized facilities of up to or close to US dollars 200 million. That's quite a large amount. And obviously that will allow us to plan for or to finance our future activities. I'll hand on to Pascal for the next section.
All right, thanks, CY. Okay, I'm going to take you on a little different track here. We're going to have a look forward and see where we are taking the company. So first I want to touch upon the mission that we set for the company for 2026. If we recall, we set ourselves a target to achieve 35,000 barrels of oil equivalent and to achieve 100 million barrels of 2P reserves. Okay. Now, if you paid attention on slide number 6, we said our fiscal year 25 production level was about 26,000 barrels. Okay. So where are we going to find the 9,000 plus barrels that we need to get to 35,000 barrels a day? So that's what this slide is about. Okay. So there's 4 tiers that we're talking about here, 4 separate projects. Let's talk about the first one. That's the for North Sabah, the SF30 waterflood phase 2 project. Yeah. So first oil and gas, first oil was achieved in October 2024. First water will be achieved somewhere in the middle of calendar year 2026. Okay. What have we done? We've completed all the drilling. So we drilled a total of 10 wells, 5 oil producers, which are on production already, and 5 water injectors. Now we've installed a refurbished topside facility. We're now waiting for the water injection facility. That will be installed in calendar year 2026. Okay. The second project is the Brunei low pressure compression project. Now, why is this one important? So we're producing gas from offshore facilities into an onshore plant, and that gets sold in the Brunei LNG terminal. You can increase production by lowering the pressure at the wellheads. Now, this is what a low pressure compression project is all about, is to lower the pressure at the wellheads, which will free up more gas to be produced. Okay, so this project is quite advanced now. It's ongoing at the moment, and we're looking to complete that sometime in Q1 next year. The next project is something we've been talking about for a while, and this is the Teal West well that will be drilled. It's going to be drilled this year. We were struggling a little bit in the beginning. There was an issue with the rig that we had contracted. That rig has been terminated, and we've now contracted a new rig that will be mobilized on the 6th of September. So drilling will commence very soon, and the program will last about 90 days. The subsea installation that will allow the production from this well to the Anasaria FPSO will be completed in Q2 2026. Okay. And then last but not least is activities related to PM3 CAA. Last year, we made a discovery called the Bunga Aster. Yeah? So Bunga Aster, one well that we immediately put into production, but to outline the size of the field, we had to drill an appraisal well, and that was done just 2 months ago. So the Bunga Aster 2 well was drilled, and this actually confirms the volumes that we estimated before we even drilled the exploration well. So it was quite successful. So we can now progress to the field development plan for this field. We also drilled in May the Pakman Nose well, and this well was projected at a certain volume. After we drilled it, it came in at a higher volume than we expected, and it's currently on production also at a higher rate than what we predicted up front. So this is pure gas production. We're currently in the process of drilling 2 info wells in the Bunga Raya field. These are oil wells, and they should be coming on stream in the next month and a half. Okay, so you put all this together, the net incremental production from these projects will be around 9,400 barrels of oil equivalent per day. And they add an incremental 2P reserves of 21 million barrels of oil equivalent. That puts us right at, or very close to, the mission that we set for ourselves in 2026. So what's next? So we recently put out an announcement where we kind of announced what the mission for the next 5 years is going to be. So we set ourselves a 2030 mission. This mission is built on 2 pillars. Yeah? So we call it Thrust 1, Thrust 2. The first one is business as usual, but grow this business. Yeah? Oil and gas remains at the core of what we do at Hibiscus. Yeah? We've built a very robust platform for growth. We now want to leverage on that for further growth in oil and gas. Thrust 2 is energy transition initiatives. I think Dr. Ken will walk you through that in a little bit, kind of what we're looking at, what we're thinking about. But the key driver for this is to generate stable cash flows, top of what the business we have already. Okay, let me walk you through Thrust 1. So I already mentioned the 2026 mission. It's on track. Yeah, we should be achieving it by next year. Let's talk a little bit about 2030 mission. And just as a highlight, we showed the 2021 mission as well. So typically, when Hibiscus sets a mission, we tend to achieve it or exceed it. 2021 mission, we exceeded by quite a margin. 2026 mission, we are on track to achieve by next year. So we set ourselves a tough target. Yeah? We want to double our production to 70,000 barrels of oil equivalent by 2030. And in doing that, we also want to build our reserves base to 2P reserves to 150 million barrels of oil equivalent. Now, how do we intend to do that? So, as I mentioned, we already have a very solid base. Yeah? Now with Malaysia and Brunei, and these will serve as our growth hubs, as our primary growth hubs. So Malaysia, we've already seen some of this growth happen. Built a trust with Petronas as a regulator, and we're getting more and more traction in new projects as they come along. Brunei, we just entered the country last year. I think we're already building a very strong relationship there. And Brunei was always a strategic acquisition. We're only one of 2 operators in the country. There's Shell, and then there's Hibiscus. And the country is looking at growth of its production, and it's going to require people taking on new assets or even old assets that have been ignored for a while. So we believe that there's quite a bit of potential for Hibiscus growth. Secondly, as I mentioned, and we've been talking about this for quite a while, is the PM3 Master Hub Plan. So with the 20-year PSC extension of PM3, we have already unlocked 2P reserves, but we've also unlocked 2P resources. We have a list of projects in the pipeline now that we can start executing on that will add organic growth. Similar story for PKMB. So PKMB was always targeted to bring production through the PM3 facilities. So PKMB, we've just completed a major milestone for it. We submitted a technical feasibility study that shows that there's an economic development for PKMB to Petronas. We are now progressing to a field development plan that will be submitted before the middle of next year. The third pillar there is PM327. So this, as Deepak mentioned earlier, is the largest exploration acreage offshore Peninsula Malaysia. It is located very near the PM3 facilities, so any particularly gas discovery would be developed through PM3. What's crucial here, when I say we have we build a solid platform to achieve this, is that we operate all our production facilities, and that gives us the flexibility to execute on the plans that we have laid out. We're not dependent on any other player to execute all this. So just to summarize, we have a balanced and diversified asset portfolio. We pretty much span the entire spectrum now, from exploration to development to production. We've even did some decommissioning recently. We have built a very strong strategic and operational track record, partnerships with national oil companies in all 3 countries in Southeast Asia. You saw from the cash flows that we generate, our financial strength is good, which gives us the opportunities to not just look for organic growth, but also potentially inorganic growth to achieve that 70,000 barrels of oil equivalent. And last but not least, we have a proven track record in acquisitions that really add value to the company. Okay, I'll hand it over to Dr. Ken.
Thanks, Pascal. So good evening, everyone. And again, thanks for joining us this Merdeka Eve on a Friday evening, so late. So I'm going to talk about the second pillar of our 2030 mission. This is to do with our energy transition initiatives, and where we are coming from when we decided to put this in our 2030 mission was to look at what the country needs, what's trending as far as the world is concerned in this energy space, and see how we could maybe do something a little different in our business going forward, and also kind of leverage on opportunities within the country. So what has been going on in the country is you would all be following the stuff going on data centers, a lot of industry building up, etc. But at the end of the day, all of this requires power, and you would also have read that there could potentially be, data centers waiting for electricity or backup electricity. And one of the things we thought about was the fact that actually we generate electricity offshore.
We have about 120 megawatts that we generate offshore, and as Pascal just mentioned, we operate all our assets, so we have a lot of core expertise on how to keep those assets all energized or powered. Okay, so we know how to do this. So we looked at it, and I think there is a sweet spot somewhere between anywhere from 5 to 30 megawatts sites around the country where people are looking for additional power, and we thought this could be something that we could build on going forward. It works with all the energy transition ideas that are emerging around the world. Around the world, electricity is becoming very important as an energy source, but the fuel source can be wind, it can be solar, it can be gas, it can sometimes oil, diesel, maybe, but not often. But the fact of the matter is, electricity is becoming very important. And what we also realize is going forward, you may have read, Tenaga is looking at a lot of capex spend to build up the electricity infrastructure in Malaysia. So we thought all of this provides an opportunity. So we've been looking at this space, how we could build some kind of distributed electricity supply kind of business unit, and in the range of maybe 5 to 30 megawatts per site. And of course, this is not going to give us the same returns as oil and gas type opportunities, but the risk reward scenario is completely different. This is onshore, it is less risky, it is long-term, very stable contracts. These things are generally take or pay with fuel pass-through. So a lot of risks are taken out of it, and you just kind of have a very stable income. So what we are looking for is to have some base stable cash flows, build up a business. So at the start of the next decade, the next time we go into another round of developing a future mission, we would be able to say, okay, our base dividend is going to be this amount coming from this stable business, something like that. So we thought we'd start doing this now. There is an opportunity to do this, and there are customers looking for power on a distributed basis. We are looking in country in Malaysia to do this, and some opportunities have already been identified. So this is what we are trying to do here, and we just put it out there because there will be progress in these areas in the next financial year, put it that way. So it's time to kind of start telling our shareholders to expect some activities in this space. So this is what this energy transition initiatives is about. What I was saying earlier is, in terms of oil and gas primary energy demand, what we see globally and what the reports, all the experts tell us, is that in terms of primary energy demand, that is the primary fuel source, there is probably going to be growth in energy demand in the next 15 years, between 2025 and 2040, of about 15%. So 15 years, 15% growth, and we'll go from somewhere around what we call 600 exajoules now to about 700 exajoules globally. But in terms of electricity, this is going to grow at nearly 80%. So we are growing 15% in terms of a fuel source, but in terms of electricity, this fuel source being converted, electricity will go from something like 112 exajoules to nearly 180, 200 exajoules. So the rate of electricity demand growing much faster than the rate of primary energy demand. So it is a good space to get into. It's size of projects now available in Malaysia, the smaller ones. We're not looking at building a 1 gigawatt power plant. We're not looking at that. We're looking at 30 megawatts, 25 megawatts, that size, but distributed, because we believe that is going to be the way of the future, distributed power plants, okay, distributed smart grids, actually. So we'll invest in this. And like I said, the returns are not going to be the same, but we are expecting that there will be several opportunities to build on. So that is what this is about. On the next slide, of course, we are going to continue. You would have noticed, CY was talking about this just now, about the I would say the cash generating capacity of the company. We are able to fund our capex. We've been able to fund an acquisition. We've been able to do share buybacks. We've been able to pay dividends. All of this with what we have from internal funds and some facilities. Our gearing has been less than 0.3, about 28%, I think. So, and the only reason we're able to do this is because we have got a capital allocation framework in place. We have very clear guidelines how we deploy funds. And as long as we follow, and you will notice here, you can see the prioritization of spend. We pay our interest and principals amounts back to banks or whoever's lent us money. The debt servicing is first, and directly after that, we ensure dividends are met, dividend commitments are met. Then we go to sanction capex, and then we are looking at other stuff. Okay, so as long as we keep keeping to this capital allocation policy, I think our balance sheet and I think really our cash flow statement is going to be robust. This is the most important thing. I would ask you to, I'm kind of almost moving on to the last slide, but I want you to just look closer and look deeper into our results. Don't look at the PAT number and then get all kind of disappointed or whatever. Look at the numbers that look at the fact that there is a energy profits levy deferred tax non-cash component in there, which is about 173 million. When you add those two numbers up, what is our PAT and this non-cash amount? You're at about 290 million. Any company that's making a really normalized PAT of nearly 300 million ringgit on a and cash flow of about 870 million ringgit and turnover around 2 billion ringgit, I think pretty strong, and doing all these making all these payments out, share buybacks, funding its capex, all of that, I think pretty robust actually. So good business, and this is in an oil price environment which is about $65, which is what most people say is where it's going to be. So kind of comfortable. We are not saying this is what our aspirations are, but we are still delivering results, good results in this world with so many uncertainties out there, with all these tariffs, all these things that keep us every day. There's a different kind of story coming out of some part of the world. With all of these things, we just know that we keep delivering the numbers, and we've delivered the highest number of in terms of production, daily production. We've delivered the highest number in terms of total sales, volumes, all of that. So everything under our control. I think we've come back with positive results. Going to the next slide, this just gives you some guidance. We normally provide guidance at the beginning of the financial year as to what we're going to try and achieve for the next financial period or financial year. So here you will find in our CBU a quarterly view on what we're going to deliver, and here we're just giving you a big picture view. So you can see in nearly every aspect of our business, we're working towards which we can control. We can control volume, we can control production, Opex, capex, what we propose to declare in dividends. These are things we can control. We're giving the kind of guidance as to what we're going to be focused on. So sales volume will be, you can see that we were right in the middle of the guidance that we provided. For 2020 financial year 2025, we said 8.6 to 9.1. We came in at 8.9. For next year, the range is trending higher. In terms of production, we didn't give really guidance last year because of the Brunei part, where we had a deal halfway, a deal complete halfway through the first quarter, second quarter. So we couldn't really provide a proper guidance, but the actual was about 9 9 million barrels of oil equivalent. Here again, for 2026, the guidance is higher than that. Opex, you can see we're right in the middle. Last year, $22 barrel of oil equivalent. This year, we're in the same range again, working towards the same numbers. And you can see the capex. We're a little bit low on the capex. We guided 283 million, but because of delay in Tail West, we've spent less money, but that money will be deferred to 2026. And again, we have exceeded guidance on dividends. Okay, so and again, we're giving the same type of guidance this year, 2026, but on a backdrop of a lower oil price range. So that's kind of how we are looking at the next 12 months. Then we go to the last slide, and it's the share price really doesn't reflect the whole story. The market is a little bit kind of lost in terms of how to see what is going to be the energy kind of outlook again in terms of demand. But what we know is OPEC has revised its 2050 forecast. Rystad has said 15% growth over the next 15 years. The Energy Institute, another source of this type of forecast. These are normally quite reliable sources, also saying about the same. And against that backdrop, the American producers are losing their position. They are producing around 13 million barrels of oil equivalent a day, and that is falling actually. It's actually falling because they are losing some of their tier one, what we call the tier one shale opportunities. They've been able to exploit all the tier one shale opportunities over the last 10 years very aggressively. Now they're having to move into what we call tier two. Tier two, the tier two situation is they have to drill more wells because each well that they drill doesn't produce as much in terms of how long it can produce for and how much it might produce. So they're having to drill more wells. Hence Donald Trump was talking, the President Trump was talking about drill, baby, drill. Yeah, they need more wells to keep their production up. But at the same time, the number of rigs actually working in the US is dropping. So quite a few interesting things. It seems that while he is asking for the operators in the US, onshore US, to do more, I think they are being very cautious. And they're just saying they will do what the price, they're just letting the price dictate what they're going to do. Again, now looking at our dividend yield, yep, we've given a good dividend yield, 6%. We've surpassed our guidance. We are giving also a kind of very, I would say, positive outlook in terms of dividend guidance for the next year. But again, I said, look a little bit deeper. I think look at what has been achieved with the cash flow that we have generated. We paid for Brunei. We paid for a lot of share buyback. We funded our capex. I think a lot of these things got done. Okay, and the capex spent 186 million actually on capex, which is quite a lot, and paid the highest dividends we've ever paid. Look also at what has happened in terms of the 2P number. When we talk about the 2P number between last year and this year, over 400% growth actually. So that is also a huge positive. Okay. So we have, Pascal mentioned it just now, we've doubled our 5-year kind of target for 2030 from 35,000 barrels in 2026 to nearly 70,000 barrels in 2030. It was not just a number we pulled out of the air. We looked at what we have in hand. We looked at what we could do. And then we said there are real opportunities out there for us to chase, and let's just set ourselves a target. Okay. We also said we would increase our reserves to about 150 million barrels of oil equivalent. And Malaysia and Brunei would be the center of these growth activities. The energy transition activities, we have a skill set and competence in company to do these power plants, and it seems that there is a gap in country, so we think we should exploit that opportunity. And we're doing all of this maintaining a very low gearing ratio, strong capital allocation kind of plan. Okay, and also we have a gearing of less than 0.3, about 28%. So a lot of things going on, which I think, as Pascal said, we have built a solid cash generating platform. Okay, it has several revenue streams in several countries actually, and it's in 50% oil, 50% gas. We are an important partner to many governments. They rely on us, and as much as we rely on them, and we operate our assets. So we are about to start the Teal West project in the UK. The well gets we mobilize for the well in about a week's time. About this time next week, the rig will be leaving the port, going offshore to do our Teal West well, long-awaited Teal West well. Teal West has had a little bit of an issue, but it was not an issue that we had any control of. The rig that we had previously contracted got stuck on another project for another client prior to us, and operationally could not come to us. They were stuck on a problem there, and we had to react, and we wanted to just protect our project, and that's what we did. So I think all around, I can't really complain about how the last year has been. So many, as Deepak went through just now, so many milestones delivered, and so many of these things. I mean, it was not just technical milestones that were exceeded. There were also kind of like commercial deliverables. The PKNB award, a new license in Malaysia. I was just in a meeting with Petronas this afternoon, and they said one of the most senior people just told me PKNB is an extremely important project for them. We must deliver it on time. Okay, we worked on we did the Brunei completion, and we have said Brunei is a very important strategic. I don't use the word strategic very much. I don't like that word actually. I always believe it's got to be economically right, but Brunei is economically right, and from an economics perspective it's right, and then from a strategic perspective it's double right actually, because we're one of two operators in Brunei, and Brunei is a country that we believe that has got more to offer in terms of having a good efficient operator there. But the biggest highlight last year was the PM3 CAA extension, 20 years to 2047. We've drilled the Bunga Astra well. We've drilled the Pakman Nose well. These are projects that are going to underpin the further development of PM3 CAA. So, and all of it just ends up by Forbes just kind of telling us that we are one of the 9 in Malaysia in their best under $1 billion list, so we were really pleased about that. Only 9 in Malaysia. I believe 19,000 companies across Asia were reviewed. 200 were finally selected, and we are one of 9 in Malaysia. So that was a nice recognition. So I think all around fundamental values, 2P numbers up, 2C numbers there, 2C the CPRs have been done. So been a busy year. Looking forward to a busier year, and we also we started getting the idea that we would achieve the 2026 mission, and we didn't want to kind of wait till 2026 to go out with a 2030 mission. So we already started working on it, and now we are working we're starting to lay down plans for 2030. So I think that's really the whole thing. Anything I've forgotten? Anything you want to add? I think okay. So I think we can maybe take some questions.
Any questions on the floor? Just feel free to raise your hand or even put on Teams chat.
Hi, Dr. Ken. It's me again, Raymond from CGS. I'd like to ask about the Mission 2030, where your daily production will rise by 100%, but the 2P reserves rises by only 50%. Could I get an idea why there's a difference over there?
Yeah, because Raymond, every year we are going to be producing between 10, 11, 12 million barrels oil equivalent is every year. As we build up to that, we are going to be also what can I say, drawing down on reserves. Yeah, so by the time you get to there, you would have drawn down at least 50 million barrels of oil equivalent, right, over the next 5 years. If you just average at 10 per year. So,
Okay.
yeah, so we want to kind of like, and at that time, when you're at 70,000, you are actually drawing down at 20, okay, 20 million barrels. So you want to be able to tell the investor, it won't be me in 2030, maybe someone else in this room, but they will be just telling you, we got 7 years of 2P life left. Okay, because we're producing at 20 million barrels of oil equivalent a year, and we got 150 million barrels there. So Deepak will be there and with the CPRs and say, here we are, we got 7.5 years left or something like that. But that was the thinking. But along the way, we are going to be drawing down as well. Yeah.
Okay, so in terms of the increase in the daily production, how much do you think are likely to come from the development of the existing assets like PM3 or PKNB or PM327 versus any future M&A?
So what we can see in hand now, and and what we want to be able to, let's just say, we got to look at oil price, where oil price goes also, okay, as to how many of the 2C resources that we have get converted to 2P and brought into production and all that. But let's say we are in a $65, $70 world, then we will not see a drop in the 35,000. We believe we'll get to 35,000, and we are then going to just stay between 35 and 40,000, I believe. That is, the projections are we will not drop below that number. Then the rest come from additional finds, or for some reason, if we get the partner for GMAT, we will be able to do some serious increases. So we are farming out. The process is ongoing right now, and probably towards the end of the year we will have a result of the farm out process, and GMAT would add something to that. But just with what we have in this part of the world, we can go to about 35 to 40,000. So we won't see any decline of the number once we get to 35. That's the idea.
Okay, so if GMAT doesn't materialize, that means you have to meet your 2030 target by way of M&A, right?
One M&A, or maybe there are also discussions about other licenses.
Okay. Right. In terms of talking about other licenses, recently Enquest was awarded Block C in Brunei, and I know that the Brunei offshore licensing round was published earlier this year. I think they're doing a licensing for Block A and D. So I'm not sure whether Block A and D have concluded and they have awarded anybody, because I don't see any news. But yeah, just wanting to ask, how come you were not involved in Block C, or was it something that was a negotiation between Brunei and Enquest predating your acquisition of Total Energies? And are you participating in Block A and Block D, or you will only participate in the future?
Okay, let me say this about Block C. So we looked at Block C in 2023. From February 2023 to August 2023, we reviewed Block C. Block C is gas in mid-water depths, about 400, 500 meter water depth. And when we looked at it, at that time we had no footprint in Brunei. What we did was we looked at it and we said, okay, this is 2023. The government gave us, what can I say, access to data in Block C, and we reviewed it for over 6 months. During that period, we realized that by the time we could bring Block C, start from zero in Brunei, in other words, we don't have any infrastructure resources in Brunei, and to get to first oil or gas in Brunei would take, and in a gas asset in 400 meters of water depth, would probably take us all of 6 or 7 years. So we decided in August of 2023 that Brunei is a great place to be, but Block C is not the asset for us. So what we did, instead of chasing Block C, in August 2023, we wrote 2 letters. One letter to the Brunei government saying we can't do Block C, but in parallel, we wrote a letter to Total and said, are you interested to sell your assets? That's what we did. And that's where we got to where we got to. Yeah, that's how we got to where we got to. Yeah.
So basically,
to answer your question on Block A and Block B, they don't intend to award it until Q1 next year.
Yeah, submissions are the submission of bids is in January 2026. So we're reviewing data. We're reviewing data.
I see. Okay.
Yeah.
Okay. So you may participate in it depending on the outcome of your review, right?
Possibly.
Okay. Okay. So you didn't take Block C essentially because it'll take too long, and probably the capex would it be far higher than what you had spent for Block B?
Certainly.
Yes.
Most certainly.
Much more.
Yeah.
Right. Okay. That's it from me for now. Thanks.
Sure. I think Garrett from Hope Asia, based in Singapore, has raised his hand. Garrett, would you like to unmute yourself?
Yes. Hi. Good evening. Can you hear me?
Yes.
Yes. Thanks for your time and the presentation. Yes, I'm a private investor based in Singapore. So just have a question about your new initiative in energy transition, if I may. So basically, what could be the potential timeline for this new power plant going forward? And in terms of capex, is it possible to share some numbers that you could spend for the first power plants? And also, you mentioned that the return on investment would be a bit lower than our traditional business. So any number you could share with us, just to have a basic idea of this new project? Thank you.
Let's say if everything goes well, we are in discussions with, at this point in time, certain technical partners who would be interested to work with us on specific projects. That's so we are building that consortium, and maybe over the next, I would say, 3 to 4 months, we would disclose something around that. Then in parallel, obviously, we are looking at certain opportunities. The sweet spot of what we are looking at is in the range 5 megawatts to 30 megawatts. We will not be doing multiple projects at the same time. We will do one medium size probably, and that's what we are targeting right now. These would be to support data center, semiconductor type manufacturing facility or data center type location, and it's in that range. If you imagine these power plants are in the range, if you are a full project developer and you do civil works and everything, then you are looking at something like $2 million a megawatt, that type of size. Then you have an idea that maybe 20 to 25 megawatt is around a $50 million project. That's kind of the thing we're looking at. Returns are in the range of 8 to 12%. Honestly, I mean that's how it is for this type of thing, and we are working on that basis.
Okay, thanks. So what would be our role in this partnership? I mean,
project developer. I mean, we would be the long-term owner of the asset, and with O&M responsibilities.
Yeah, and in terms of expertise and skills to run that kind of project.
So we are running right now 120 megawatts offshore on all our facilities that we are running. So this is some of them in the range of 15 to 20 megawatts, a single site. So we've thought that we can leverage on that because we're already doing it in a more marine environment. Here we are doing it on land, a little bit, let's say, less, less difficult, I think. Yeah.
Yeah. And of course, it's a bit too early, but any idea that when you would like this project to start?
We want to be able to get to 2030 with a base where we can start looking at it, and there is a window for this, because come 2030 all the data centers that are going to be built would have been built probably. So there is a window for us to do 2 or 3 of these plants and build a base in the next 5 years, and that's what we have to do. We have to put in place like something like 50 to 100 megawatts of power on this basis, something like that, and see whether we can get that scale going onshore.
Okay.
Which is, I mean, over 5 years is quite a lot, huh?
Yeah. Okay.
Yeah.
Thanks for sharing. Quite exciting project. Yeah. That's all for me. Thank you.
Thank you.
Thanks, Derek. Question from Homing from UOB-KH. For your smart grid or energy transition strategy fitting into your future dividend ability, which listed do you benchmark against or try to model the business model towards? If not, do you plan to do it on your own, or do you still need a strong partner?
As I just answered, we are hopefully in the next quarter we will be able to provide some visibility on who are the partners, and I think when we do, the market will be excited, I think, to hear about it, the partnership we're trying to put together. But we'll be the main project developer. That's what we're thinking.
And also, we are not benchmarking against any other listed company. This is something that we are doing on our own.
Yeah.
If there's and Russia brokered by Trump, where do you foresee oil prices heading in the short term and medium term?
I'm not thinking that there's going to be a peace agreement anytime soon. The behavior of these, of the principals involved in all these discussions don't seem to be heading that way, actually. But anyway, we wish that they have some peace. But we think even if there is peace, people are not going to just, let's say, entrust Russia to be their energy source anytime soon.
Okay, so more question. If Brent drops $9 per barrel, can you still sustain your dividend at 9 cents per share per annum, or if you need to reduce it, to what level would your dividend be?
Last year we were talking about trying to keep our dividends going at $80 and $70. But all we've done is we have managed our cash flows. We have generated more cash flow this year than we did last year on a lower oil price. So we just, and it all comes down to the fact that we operate our assets. So we're able to phase our work. We're able to look at what we can prioritize. But I mean, every time you read the press, apparently oil price is going to go down some more. It's quite interesting because OPEC, I was looking at the numbers. OPEC has actually unwound all its production. Give me a second. I was just looking at these things. Okay, it's quite interesting. The OPEC has unwound all its production. They've got no more to deliver from what they cut back before. The US is also seeing a drop in production. So I'm trying to understand, and yet everybody is projecting that primary energy demand is going to increase by 15%. So I'm trying to understand where that comes from, actually.
The oil price.
Yeah, where is it coming from? And if the oil price goes down some more, there's going to be even less investment. No shale producer at $55 is going to be drilling second-tier opportunities. So when you look at all these and you try to join the dots and you try to make sense of it, you say, well, if people do that, then the service companies will be looking for work. There will be an opportunity to bring down our OPEX per barrel. it will not be something that will be sustainable for a long time, because immediately when oil prices go down, capex projects will be cut, and then you will start having a supply will start tightening, and then you'll have oil prices go up again. So it might be possible that somebody decides to put a 500% tariff on China tomorrow or something like that, and oil prices might drop $10 for a week. And then 1 week later, they will say, oh, we're suspending it for 3 months. So, all these things can happen. But we just look at it. We're in a long-term business. We planned 5 years. We planned in 2021 for a 2026 objective. Here we are on the eve of 2026, delivering on those objectives. Today, we are preparing for 2030. We are just in a long-term energy supply business. And if we start worrying about short-term kicks in oil price, very difficult to function, and then you just don't invest. So we just come up with our investment plan. We have our capital allocation policy. We prioritize dividends. So it's top dead center in our mind what we have to deliver. We just try our best to do that. And we look at this oil price and
there seems to be a misconception that Russian oil production is curtailed. Similar to, same thing with Iran.
Yeah.
People think Iran and Russia are not producing at full capacity, but that's not the case.
Yeah.
So they are selling every single drop of oil that they produce.
It's just at
a reduced price.
Yeah.
Because that's what the sanctions do.
They're selling it at a reduced price. Why do you think India is being sanctioned by the US?
Yeah.
India is being sanctioned in the US because they are buying oil from Russia, and they're sticking to their principles. Russia has been a long time supporter of India, and India-Russian relationship goes back to before independence of India. So all of this, Russian oil goes to India, Russian oil goes to China, and there's no additional oil. There might be some additional gas that might become available to Europe, but in terms of oil, I don't think so. That's not it. All that's happened is the rerouting. Oil just got rerouted when sanctions were applied.
Since we are on the topic of dividend, there was a question also asked earlier as to why we have 5 interim dividends versus the usual 4.
It's because when we received the PM3 CA extension, and it was unprecedented because it's never been 20 years before, it's always 10 years, and because of that we decided to give a special dividend to shareholders.
Yeah.
I think just to fall back to Ho Ming's, he just wanted to remark back. So he said, got it, no need to benchmark to others. You only benchmark against yourself. You did very well as a small independent to produce oil versus the 7 sisters. We're now emulating the same business model like a small energy independent producer to fill in the gaps of those that need electricity. But the big weight players will not guarantee to provide for all data centers. So if this works, it will show that Hibiscus remains the same. Doesn't matter whether it's oil or cleaner energy. Best of luck for your energy transition.
Thanks, Kuming.
Thank you.
I know. I just want to just bring that up. So from Garrett again, what is the average cost of production of oil and gas for the company?
We disclose the oil and gas. Our average cost of production, unit production cost was $22 per BOE. That was for FY2025.
Ho Ming has gone on. Ho Ming, have you had time to compute yourself?
Yeah, before you all go off, have a good Merdeka weekend. You all are kind of dropping off, so have a good Merdeka.
Don't drop off.
Don't drop off yet.
I'm not utility analyst, I could be wrong, but if the ASEAN Power Grid can push for a platform for small energy producers like you to provide for whole Asian region, it strengthens your demand markets also, I think. I'm just making a statement.
Yeah.
Thanks, William, also for that.
I just close up by saying, just look closer, look deeper into the numbers. That's what I'd like to say. Very important.
Okay. Then if that's the case, thank you again for joining us this evening. If any queries, please feel free to reach out to us.